Sergio Ermotti, welcome to Bloomberg. We look at the numbers, the investment bank and the wealth management, a barnstorming investment banking side and a stoic wealth management. What drove the IB this quarter?
Well, first of all, I would add that our asset management division also performed very well. All our asset gathering businesses were very engaged with clients, and I think that during the quarter, I would say there was a mix of seeing the fruits of our investment in technology, being a front-to-back technology-saving company, but also the value of advice was very important. So, on the IB side, I would say the FX business and rates and credit business were very strong, more than 100% up year on year in equities, in cash and prime brokerage. We also had strong results. In wealth management, we had a very strong performance, plus 70% in Asia, plus 16% in Europe, 3% in Switzerland, offsetting the US, where we saw the effect of the net recurring fees being based on the previous quarter close ends, impacting our profits.
Was there any sense of caution in the clients? I came from Julius Baer. They had an explosion in client activity. How would you describe your client activity in this quarter?
Well, it was still very active, of course, more of a wait and see, starting to think about the second half of the year, which is full of events and which potentially will also trigger a change in investors' sentiment. The geopolitical situation that we all know about between the US and China is going to a next level and situation in Europe, which as we speak is probably resolving, but is still very complicated. And last but not least, the US elections, which according to our clients, 61% of our clients are thinking about changing their asset allocation post the election, no matter who wins.
Do you think that's what's holding them back, the election over China and trade?
Well, I wouldn't say that people are holding back. It is true that the conviction level of clients in this rally in the market is not something typical, but it's not dissimilar to what we saw in the last few years. Markets going up with low volatility, low conviction, and clients keeping their asset allocation pretty steady. Now, I do expect this to change toward the end of the year.
Does it concern you more that it takes an explosion in volatility, credit spreads, and an implosion in equities to drive these clients to actually really shift gears?
Well, of course, when you have this kind of movements, after the first shock, people start to look at opportunities to step in, to build up positions in different shape or forms, either through cash or through derivative transactions.
Your global outlook has a 70% allocation to a base case and a 30% to crisis. Talk me through your basic scenario as it stands right now without a vaccine.
Well, our basic scenario, the 70%, is de facto based on severe economic contractions in the next few quarters and with a recovery, although not to the same extent that we will see the slowdown in 2021 and then coming into 2022. The 30% is a severe recession, and this is really the one that we need to put in our models in order to have the prudence necessary.
Look, in the past 24 hours, vaccine and volatility, they've combined, haven't they? The narrative has shifted. Could a vaccine deliver the kind of alpha for markets in the second half that the dislocation that we've seen in the first half? Could this vaccine really change the V narrative?
No, the vaccine probably could give a better hope, in my point of view, at least for the midterm, not the short term. The short term, yeah, maybe there is a little bit of rebound, but a lot is priced. A vaccine would not be impactful in the next 12 months in any case. So I do think that the reality is that what we will experience after this crisis is that many companies will be able to make it and go through and be probably even stronger or be well positioned for the future. And the one that were already struggling before the crisis probably will have a hard time to recover. And this is where you will see probably still a second leg of the economic consequences of the crisis being played out.
With that scenario, are we Are we underpricing, underassuming the level of defaults that will come globally?
Well, it remains to be seen, but it is fair to say that markets remains quite complacent, I would say. That there is not a lot of, if you look at equity markets, even credit, which were quite a good investment pick, as we spoke last time.
You did make that call, to be fair.
Well, now they are, if you look at spreads have been come in, and therefore there is not a lot of room for many negative surprises going forward.
JP Morgan says that as far as the credit markets are concerned, we are in a hallucinogenic moment. We're locked in a collective hallucination in credit markets. Does that chime for you in Europe, in the US, Sergio?
Well, but it's not very surprising if you see across all asset classes the amount of liquidity and money around is driving this kind of situation. So one has to really continue to look at a huge diversification and not avoiding concentration on any kind of asset class or underlying.
You still think there's mileage in credit, though, even at this stage with the central bank backstop?
Where in some areas maybe there are opportunities to pick up, but as I said before, the name of the game is diversification and also taking a little bit maybe liquidity risk on certain kind of investments in return of higher long-term returns.
Can we circle back to the bank in terms of dividend? What is the probability in the third quarter that we get the second payment on the dividend? How optimistic are you?
Well, we are quite confident that we are definitely in a position to pay the second tranche as expected. You saw our strong capital generation in the first 6 months, 3.6 billion of capital generation. Our ratios are not only the CET1 at 13.3, but our post-stress CET1 is at 11% and more than 11% actually, and so we are confident we can pay the second tranche. And FINMA, our regulators, has already made it public that they agree in principle with our capital return policy for the 2019 dividend.
You also talk about the prospect of dividends in the fourth quarter of 2020. Is that an ambition, a hope, or really a commitment?
A share buyback.
Share buyback,
share buyback, yes. Well, no, it's not a commitment, it's a possibility. I think that, of course, the situation out there is still very challenging and very difficult to predict. So we should never be complacent. It's a strong first half, but we are also very focused on managing the second half of the year, but also with a level of confidence that should the situation continue to be somehow benign in respect of our business, we should not rule out at this stage, some degree of share buyback, but it's too early, and we will update at the end of next quarter.
And to close, it looks like Europe has got themselves to the point of where they have a deal to help Europe along with a fund. Your reaction?
Well, I think it's positive that they finally find a solution. I always find a little bit concerning, if that's the right word, that it always takes so much drama and work to get a solution. And I think that one would expect that in managing a crisis like the one we had, more decisiveness and then more commitment by the policymakers and politicians around resolving those matters would help to reinforce the credibility of the institutions as the European institution in the eyes of many people out there.
Sergio Ermotti, CEO of UBS, thank you very much for joining Bloomberg, sir.
Thank you.